Nebius Group, which provides infrastructure to develop artificial intelligence capabilities, reported revenue that increased 625% year over year and 106% from the previous quarter. Of course, that kind of growth has a lot of investors excited, and investors want to know what's going on with Nebius Group stock. I'll talk more about this business, elaborate on what the management team delivered in their latest earnings call transcript with Wall Street analysts, and what it could mean for Nebius stock investors. Let's jump in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So as I mentioned, Nebius Group more than doubled their revenue for the whole group from the first quarter. So quarter over quarter, doubling their revenue. And they also became EBITDA positive in their core AI infrastructure business ahead of previous forecasts. I always like when a company provides a forecast of when they expect to become profitable or when they expect to release a new product and they beat those expectations. Now, that's different from when the company provides a forecast for revenue and earnings per share for the quarter ahead or for the full year, and they consistently beat those forecasts. Then I'm not a big fan of that, because that demonstrates that they're consistently underreporting their forecast and underreporting their expectations. And in other words, sandbagging investors and then beating those expectations. But when it's a newer company and they're trying to hit profitability for the very first time, or they're building some new project for the very first time, and they do it better than expected or sooner than expected, then I take that as a very positive sign. In opposed to when it's a more mature company and the mature company is regularly beating expectations, that's more a sign of a company that's sandbagging investors, and I don't like to see that. So in this case, this was a positive sign for Nebius Group investors. The management team saying like, hey, we could have grown faster, but we were oversold on all of our supply of previous generation hoppers, and we decided to wait for the new generation of GPUs to come. And the new generation is the Blackwell technology that was launched by NVIDIA this year. And remember, NVIDIA said that they are now going to develop new technology every year. Whereas previously they were doing every 2 years, now they're doing it every year. And as I shared with you, I did several videos from NVIDIA's conference call, a similar conference call that NVIDIA held with Wall Street, and they said that they're on schedule to do this every year. And that's going to continue creating demand because it's a catalyst for enterprises to purchase and incorporate this new technology that could give them an advantage against other providers that are still on the older technology. So Nebius is waiting for NVIDIA to send them the latest generation Blackwells, and when they get their hands on those, they will implement those. And right now, Nebius is in the position, as many of these companies are in, with demand exceeding supply. And NVIDIA is in the same position. Demand for these types of investments to build out these data centers optimized for artificial intelligence, demand for this far exceeds supply. And businesses are spending several $100 billion. NVIDIA's estimate was that businesses, enterprises will spend roughly $600 billion this year alone on building out these data centers optimized for AI. And that's roughly double where it was a couple of years ago, and they expect that growth to continue, surpassing several $1 trillion over the next few years. So as a result of their positive performance, Nebius Group is increasing their ARR guidance, which is annual recurring revenue, for the end of the year from the previous 700 to 1 billion estimate. Now they're saying they believe it's going to be between 900 million and 1.1 billion. So at the midpoint, they went from 850 million to 1 billion. So an increase of more than 15% at the midpoint between where they stand as they reported these results at the end of August to where they expect to be by the end of the year. Management said we are aggressively ramping up. And I don't blame them. If I was operating this kind of a business with this kind of demand and this kind of signal from customers, I would be ramping up too. So the company saying they expect to have secured 220 megawatts of connected power that's either active or ready for GPU deployment. And this includes their data centers in New Jersey and Finland. And that's one of the constraints with developing this technology, the new data centers optimized for AI, is securing power to support these buildings. Remember, these data centers optimized for AI consume multiple times more power than traditional data centers that were not optimized for artificial intelligence, that were based on CPUs as the primary component. And now they're based on GPUs as the primary component, and they consume a lot more power. Every search engine search takes a fraction of the computing power that every question to a large language model takes. And so as people are using large language models more and more every day and switching those from the search engine results, that's consuming a lot more power. And these companies have to secure the power, work with local regulators, cities, and governments to secure the power to support these data centers so they can get them built. By the way, this document that I'm reading from is the company's latest earnings call transcript. And I've made this document available for my channel members. And you can join my channel for less than $5 a month. You can see the link in the description for all the benefits you get as a channel member. This is just one of them. So I also wanted to share with you my recommendation for Nebius Group. I only recently placed a rating on the company on September 1st. I've been following the company for about a year now. I don't think there's enough to justify a buy recommendation for Nebius Group. So I have the stock rated as a hold, but I think it's closer to a buy than a sell for sure. I'm waiting for more information from the company, more information from the market, and evaluating this business closely because it's growing so quickly. It's hard to get a grasp on this one. It's definitely a high risk, high reward type of situation. And for investors with a very high risk tolerance, for now, I have the stock rated as a hold, but I wouldn't be surprised if the next move in recommendation is up to a buy instead of down to a sell.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.